No, it just got dragged. Modi ji wouldn't stop talking, so what to do?
Yeah. So I missed her this time. So hopefully next time.
Well, the more important thing was that you were there.
Ji, thank you.
I know. So I think it turned out to be good. I think she was quite receptive.
Namaskar.
Yeah.
Namaskar, Saket ji, our senior VP sahab. Namaskar.
Namaskar, Sharma ji.
It got a lot of good press coverage also. Next day also people called me up and said, "Arey yaar, tumne bataya nahi, FM was coming to PhD."
No, I think it was a good initiative, and I think these are symbolic. The fact that she came.
Yeah.
That's the important thing, that she wants to open that channel and keep it open.
Yeah. मैंने किसी को नहीं बोला कि मैं I missed her. I said, yeah, she was great.
ठीक है, fair enough. Fair enough. I think all of us being there was enough. Hi, Mukul ji. How are you?
Hello, ji. Very good, Apada Saket. Thank you for being here.
My pleasure. My pleasure.
You have a lovely background.
Thank you. One of the perks of the business I'm in.
Yeah, I think it's a major promotion. I think promotion. Yeah, absolutely.
ठीक है, अक्सर PhD का background नहीं रखूँगा, यही रखूँगा.
Yeah. Right.
In that sense, my house is also decorated with all the marble from his.
Okay.
I hope all good, because it's a thankless job usually.
Okay.
You see, in natural material, personalized jewelry, nobody bitches in public. But when it comes to your flooring, everybody takes a day at you.
Chaliye. So I think Sharma ji, we can start the program since Saket ji also has to go for another program.
Thank you, sir. Thank you, Senior VP sir, for joining us. A very good evening to all. On behalf of PhD Chamber of Commerce and Industry, I welcome you all for today's webinar on changes in direct taxes in the Union Budget 22-23, being organized by Direct Taxes Committee of PhD Chamber of Commerce and Industry. Honorable Finance Minister has reiterated the need for capital investments as it holds the key for speedy and sustainable revival of the economy, because we saw severe downfalls in the 2020 and then we recovered from the lows, extreme lows, to the high growth trajectory of 9.2% for the current financial year. So now the focus of the government is to sustain this growth to the next level, to become more and more strong and sustainable in the coming times. Like in the previous years, this year as well, the Honorable Finance Minister kept away from the from making too many changes in the tax rates and tax laws, thus presenting to the world that India is inching towards a stable tax regime. The high growth in the tax collections, both direct and indirect, is an example of India's moving towards the stable tax regime. The proposals are intended to simplify the tax system, encourage taxpayer voluntary compliance, and eliminate litigation. So more and more simplification of the taxation system is required and is undertaken by the government, moving forward with the more and more ease of doing business, so that ease of doing business is becoming fruitful at the ground level for the benefit of industry, trade, and particularly for the MSME sector. So with these words, I would like to invite our respected Senior Vice President, Shri Saket Dalmia ji, for his welcome remarks.
Thank you, Sharma ji. A very warm welcome to all our participants today. Am I audible? Yeah. Thank you so much, Mukul Bagla ji, our Chairman, Direct Taxes Committee at the PhD, Sachin Jolly ji, and Pallavi Dinodia ji, the co-chairs of the Direct Taxes Committee, Mr. Sharma, our Chief Economist, and all our senior and esteemed members. I think we have all the specialists on board to really discuss threadbare about the changes which have happened in this budget. What I would like to share is that the recent participation which our chamber had, along at times with me and at times with the specialist team, pre-budget, post-budget, with the finance minister coming herself to show her assurance, having a frank discussion with the revenue secretary, Tarun Bajaj recently, having the CBDT and CPIC chairman along with them, reading this morning, I think some of us must have about what the Revenue Secretary said about rationalization of taxes. So one thing what we are seeing in front of us is that the top level is receptive to what we want to say. I think in the past, it has been a one-way traffic where we give a proposal, we do not have an immediate reaction, we do not get an opportunity to interact on particular laws. We are seeing a sea change in that when we are interacting with the senior administrative wing of the government, especially towards revenue and taxes. The benefits of that is obviously that whatever is the pain at hand, we can at least bring it on the table. Obviously, there will be many points which will not be addressed. There will be many wishes which will not be taken care of. One thing is for sure that we do get an immediate reaction, and if we don't, we get a clarification. So with this kind of an environment and background, and with the proactiveness of our chairs and co-chairs, I think one, we will continue to really now take a leadership position, I think, in influencing the government where it relates to taxation matters. We hope to continue this leadership with a wider participation by members of the chamber so that our leaders who specialize on this committee are able to bring to the table to the administration the pain points and whatever the concerns are for our members. Having said that, I think it's about time that we discuss about the changes which have taken place, which could not take place from the eyes and from the participation of our chairs. So giving the mic back to Sharmaji and looking forward to an interesting discussion. Thank you once more.
Thank you, Shri Saket Dalmiaji, our Senior Vice President, for sparing your valuable time from your extremely busy schedule today. So now I would like to invite our Chairman of the Direct Access Committee, Shri Mukul Baglaji, for his theme presentation to the participants on the recent changes in the direct taxes in the Union Budget 22-23 and its way forward for the next growth level of the economy. Shri Mukul Baglaji, please.
Thank you, Dr. Sharma. Thank you, Saket ji, for your wonderful opening remarks, which were very, very pertinent. And yes, you are very right that the Honorable Finance Minister and the Revenue Secretary have been extremely receptive to our ideas. Of course, not that they'll implement everything that we request, but yes, they have definitely picked up a few of the things which we had suggested, including the taxation on cryptos, the extension of due dates for startups, extension of due dates for new manufacturing concerns under Section 115 BAB. So they are receptive, and I'm sure with our ideas, which we get from our members and from our co-chairs and the entire committee, I think things are definitely improving. I welcome you all to this program on the deliberations of this year's budget. Well, since the budget day, there have been endless talks on whether the budget was good or bad. Honestly, it's very difficult to give your perspective of, especially from the tax angle, at how good or bad the budget was. But I think the budget these years, like this year's budget and also the budget in the past a few years, they basically have three major aspects. One is the rationalization of tax rates. I feel that India has reached a stage where there's stability of tax rates. Like started with September 2019, when the Honorable Finance Minister reduced the corporate rate tax rate to 22% and 15% in respect of companies which were starting manufacturing operations before a cutoff date. So the government has done enough on the corporate tax front, and it is extremely unlikely that any further tax cuts will happen on the corporate front, at least for the next few years. We, as a part of the chamber, have had the opportunity to meet the Honorable Finance Minister and the Revenue Secretary after the budget day. A few of the queries were raised before the Finance Minister and the Revenue Secretary by our members. And some of our members, they were requesting for some further incentives to the private sector when they're increasing their capacities and setting up more more manufacturing units within the existing companies. So the Honorable Finance Minister was extremely clear that after reducing the corporate tax rate to 22%, no more incentives like the additional depreciation or investment allowance should be expected, as these rates were cut to remove these incentives at the first place. So the stand of the government is very clear. They want to simplify the tax system in the future, have a lower tax rate, and remove all the incentives and which were there for expansion and for other reasons. Of course, they still retained the incentive of creating more employment by retaining Section 80JJAA. But other than that, I would say that almost everything has been phased out in the new 22% tax regime. Well, yesterday, interestingly, the Honorable Revenue Secretary has hinted that in a press conference that he wants to restructure the capital gain regime, and he says that there are too many rates, there are too many assets, so he wants to kind of club them and get them into probably lesser number of assets, lesser number of rates. So let's see what he comes up with. Hopefully, probably in the next budget, I foresee that something may be done on that account. On the tax front, I have a view, and this view has been shared by our chamber whenever we go for meetings at the North Block. Well, a lot of our businesses are run as partnership firms, as LLPs and sole proprietorships, and such entities are taxed at 30% plus surcharge, as against 22% for corporates. So I feel that there's no level playing field. Even the salaried employees are taxed at the rate of 30%, and the rate of surcharge goes as high as 37%, resulting in a tax rate of 43%. So I don't exactly understand when companies which are cash rich, which have huge amount of money invested in fixed deposits, companies like Infosys, TCS, Reliance. So why these corporates are taxed at 22% and a salary payer is being salaried employee is being taxed at 30%. So this perhaps from in the next budget, I think we have received enough hints that this situation would be rectified and some relief would be given to the individual taxpayers. But let's see, it's still I think still it's everything is in the pipeline. Let's see what they come up with. What I also observe is that when this tax cut happened from 30 to 22, there was a tax cut of 40% from 30% to 22%. And in spite of that, the direct tax collections of the country have gone up by 40% from financial year 1920 to this year, that is the figures till December 21. So if by cutting tax rate by 40%, the tax collections can increase by 40%, that clearly shows that by a reduced tax rate, the level of compliance and tax adherence is really increases in our country. So all the more reason that now that a lot of it has been done on the corporate tax front, I think now there is the case to do it for the partnership firms, the LLPs, the sole proprietorships, the salaried class, so that once their tax rates are reduced, I'm sure there'll be a lot of tax buoyancy on this front also, because people definitely will become more tax compliant. The next aspect of the budget these years is to make new laws on the ease of doing business. This year we have seen various provisions like filing of updated returns, which clearly shows that the government wants to make has its thrust on ease of doing business. I would not say that there's not room for more. There is room for a lot more, but I feel that the government is doing its bit. I think the government is definitely working on that. The next aspect I feel which the budgets are these days are taking care of is the plugging loopholes for tax evasion, and also settling disputes on various tax controversies. We have our co-chair Sachit, who will be concentrating on some of these tax controversies of the past and how they have been settled in this budget. Some of them retrospective, some of them prospective, and we will look at his view on those. For the plugging of loopholes, there has been changes on account of bonus stripping on shares, which has been imposed. there has been withdrawal of concessional rate of tax on overseas dividends, and the losses that the unearthed income which have been discovered during search and surveys, they are not being allowed again to be adjusted against brought forward losses. So a lot of things are happening on plugging of loopholes also, which a lot of taxpayers had found over the course of time to avoid their taxes. So I just give a brief breakup format of today's webinar. So I'll be starting and giving my deliberations on few of the provisions, after which I'll be followed by Ms. Pallavi Dinodia Gupta, who will be addressing some of the other queries, other points of the budget. And finally, Mr. Sachit Jolly will be taking care of the remaining provisions. After we finish with our sessions, there'll be a question answer session, and wherein the questions of the audience will be taken care of by all of us. So I would request all the delegates to participants to put their questions on the chat box available on this portal. With this, I would like to start with my deliberations. So I think there's a PPT for this. I would request Pallavi to put that, please. Yeah, thank you, Pallavi. So I start with the various changes to the tax rates. As we discussed, there's not much changes which have happened there. There has been some changes to surcharge rates on cooperative societies. I'm not going into that. I think a good and a welcome change which has happened is the capping on the surcharge in case of capital gain, which has now been capped at 15%, irrespective of the amount of capital gain. So previously, this was restricted to only Section 111A, 111A, and 112A in respect of long-term capital gain on listed shares. So, but now they have done it across the board. So, like if you have a property, probably you sell it and you get a long-term capital gain of 10 crores. Your total surcharge would be 15% only, and not 37%, which was there earlier. So now, going forward, your surcharge will not exceed 15%. Earlier, the peak rate of long-term capital gain was 28.5% tax. Now it has been reduced to 23.92%. That is 20% plus 15% plus 4%. So it comes to 23.92%. So that's a very welcome change. It saves a lot of tax for people who have made long-term capital gain on sale of properties, etc. Well, the next slide, which is on, this is another big change which has been made on promoting voluntary tax compliance and reducing litigation. A new provision, Section 139(8)A, which has been added which gives an option to the assessee to update his income tax return. So the finance minister was very, very candid in her speech, wherein she discussed that it's only for mistakes which have been made in the original return. So she gave an example of now, since the income tax department has access to all the transactions, the major transactions which an assessee does during the year. So if there's any deviation which the assessee finds that some of the transactions have not been reported by him in the return, he can update his return. And of course, everything comes at a cost. So it's not that he can just simply revise his return and we feel happy about it. Of course, there's a substantial cost attached to it. So if the updated return is filed within 12 months from the end of the relevant assessment year, additional tax shall be 25% of aggregate of tax and interest on such additional income. So this 25% needs to be paid on the tax on the additional income and the interest thereon. And if the updated return is filed after 1 year, but before 24 months, then the additional tax is 50% of the tax and the interest on additional income. So a return can be revised also, as we all know, right? Under Section 139(5) of the Act. And return can be revised, but the return can be revised only within 3 months prior to the end of the assessment year. So if my assessment year, for example, is 21-22, So I'll be able to revise my return only by 31st December 22. So my question is that there's hardly any time left to revise the return any which way. So in theory, this updated income tax return seems to be a very good option. But it has its cons. An updated tax return can't be filed if the assessee has been some search or survey operations has been initiated on such person, or the assessee has received notice in respect of some documents which have been found against him in case of search and survey in case of any other person, or some assessment or reassessment is pending in the case of the assessee for that relevant year. And of course, there are a few other cases. Some of them are important, like an updated return which has the effect of decreasing the total tax liability or increasing the refund amount cannot be filed for that. And an updated return which shows a loss also cannot be filed. So therefore, if you have a loss in your return and you want to increase your loss or decrease your loss, in that case, the updated return cannot be filed. So we have had a lot of deliberations on updated returns. In my opinion, it has very limited applicability. It might be a non-starter, because see, most of the mistakes are often taken care of during the course of the reviewing of the returns when they're done by qualified chartered accountants or lawyers. One major aspect which we thought could be covered by this would be in case some incriminating document is found at someone else's search, and before you get a notice, you revise your return and update that. But unfortunately, we've had a lot of deliberations with Mr. Kamlesh Vaishnaji also, who is the head of TPL in India. So he has clarified that it is only for genuine mistakes. It is not for any undisclosed income. Like I'm sure everyone will be aware about Section 115 BE, which says that any amount of the tax on income under Section 68 or 69 would be 60% plus 25% plus surcharge. So any undisclosed income would be taxed at the rate of 60% plus surcharge, and you can't take the benefit of this updated income tax return under Section 139(8)(a) for something which has suddenly been unearthed in a search at someone's place. So that's something which is, in my opinion, it's a non-starter. It may not have a lot of applicability in going forward. Coming to the next slide, please. So the next point is, I think this amendment related to the successor entity subsequent to business reorganization. This happens post mergers and demergers. It's a very important change which the government has done. We have had. So I'll go you first. I'll first go through the section, which is Section 172A, which has been inserted. It proposes to provide that in case of succession of business under any application before adjudicating authority or any high court, any assessment or other proceedings pending or completed on the predecessor shall be deemed to have been made on the successor. So some courts have held that where assessment is completed on an entity which is no longer in existence after the merger order, such orders will be non-est in law, and so therefore they will not be applicable. So I think to overrule these rulings, it has been amended that such addition made in the order of the predecessor shall be applicable to the successor company also. So just to give an example, that if you have 3 companies are being merged into the 4th company, so any assessment which has been done on the 3 companies will stand and prevail and will be deemed to have been made on the 4th company. So it's an interesting change, probably more revenue friendly, I would say. Most importantly, the Section 170A has been inserted, which enables the successor entity to file the modified return in respect of business reorganization through an order of the High Court or the NCLT. The modified return can be filed for the period starting from the appointed date till the date of issuance of the order or the closure of the financial year, whichever is earlier. So such modified returns can be filed within 6 months from the end of the month in which the order of reorganization has been issued. So till now, what was happening was that suppose a merger starts on 1st of April and probably takes 2 years for the merger order to happen. So the return was to be revised from the appointed date, but since the time limit for filing of the revised return for that assessment year had elapsed, it was not possible to revise the return legally. So the Honorable Supreme Court, in the case of Dalmia Power Limited, had allowed the filing of the revised return, as there was a specific clause in this scheme of amalgamation that a revised return can be filed. But that's not the end of the problem. The problem was happening because these returns could not be filed electronically, and they were filed manually, but the income tax department was not processing these returns. So I hope now with this amendment coming, they will make some changes to the portal as well, and they'll allow the SSC to file these revised returns through the portal so that they can be processed seamlessly. Another very important changes that has been made to section 156A, which has been inserted, or rather proposed to be inserted, wherein the outstanding tax demands, including penalties, which have been modified pursuant to insolvency and bankruptcy code orders. So earlier, the income tax department did not have powers to delete those demands. So now this section has been introduced, with which the income tax authorities would be able to modify these demands which have been cancelled or amended by the NCLT or the other courts. Well, this has been our most awaited demand from the Finance Ministry. This is regarding the extension of the last date for commencement of manufacturing under section 115 BAB of the Income Tax Act. We all know that we already discussed that in September 2019, we had section 115 BAB was introduced, wherein it says that concessional tax rate of 15% shall be payable for new domestic companies set up and which commence manufacturing up to 30 March 2023. So this was done and introduced in September 2019, and COVID happened in March 20. Suddenly, the demand of all consumer goods and capital goods eroded. People were not sure whether they need to actually expand or not. But yes, now the situation have become normal. The businesses are booming again. So the government has correctly taken care of that, and they have extended it by one more year. I don't know whether 1 year is sufficient. We talk about Tesla and other companies coming to India. So probably to lure these companies, we could have some more extension. Let's see what happens in next year's budget. But we'll, as a chamber, would definitely want to request for further extension for this date as well. This will really give a lot of boost to the manufacturing sector. The next change is in respect of the startups. There's been a Section 80 IAC which gives a 100% deduction of profits to startups for 3 consecutive assessment years out of the 10 initial assessment years. So the earlier provision was that the startups should have been incorporated by 31st March 2022. This date has been extended to 31st March 2023. Again, a big boost to the startups. We have new startups in India coming, and we're having unicorns getting made by the day. So I think this change will definitely help in having more startups and more successful startups in the future. Well, widening and deepening of tax base, a new section which probably is giving shivers down the spine of a lot of taxpayers, businesses which are more in the FMCG business, wherein there's been a new section 194R which has been introduced, regarding the TDS on benefit like gifts or traveling expenses or conferences, basically defined as a perquisite of business and profession. So a new section 194R has been inserted, which provides that where a person responsible to provide any benefit or perquisite arising from business and profession to a resident, such person shall deduct TDS at the rate of 10%. So I think the reading of the section is pretty clear. I'll give you a brief background for this section. A lot of companies in the FMCG sector were giving gifts to their dealers, distributors, agents in the form of cars, bikes, gold coins, and a lot of things, a lot of expensive things, electronic gadgets. So what was happening was that the company was debiting the expenditure in their books of accounts, claiming it as a business expense, and whereas the recipient of these assets, like the gold coins or the cars, they were not showing them in their return and not paying tax on that at all. So the government wants to plug that loophole, and they want to make sure that such gift given to the distributor is taxed is shown as income in the hands of the distributor as well, because once it will be reflected in his 26 AS, then the dealer will have to disclose it in his income tax return also. Here, there's some sort of I think a lot of clarity is required in respect of the other aspect of section 194R, which concerns the foreign travel part, or probably even a domestic travel part, or there could be other benefits also other than gifts. We see that a lot of conferences which happen abroad or locally, wherein the FMCG companies, they take their dealers for a free travel, for a free holiday, sometimes which is linked to the amount of goods that they are able to sell. It's like an incentive. So if it is purely an incentive based on amount of goods they have sold, I'm sure this would come under the definition of benefit or perquisite. But in case of a conference which is open to all dealers, and the idea of the conference is to educate the dealers on the products of the company, how they are better than the competitors, and basically more of an educational trip or something which can be shown as an educational trip, I feel that that may not fall under the definition of benefit which has been provided. We have requested the CBDT to issue a circular on this section, because this will create some litigation and some doubts. So let's wait for some more clarity on this account from the CBDT. Well, this provision is applicable only where the value, or just me once. Shamri, can you request somebody to mute someone in the panelist, please? Sharma, can you hear me? There's a lot of cross noise coming. Please, can you just mute your system or the other system?
Please mute, sir.
Okay.
My system is.
The host system where the advertisements are coming is one which is unmuted and creating noise.
Now, yes, it is muted now. Now it is fine, I think.
Now it's fine.
So let's mute everyone except the person who's speaking, right? Thank you. So this section is applicable where the value or the aggregate value to be paid exceeds rupees 20,000 during the year, and this is for both monetary as well as non-monetary perquisites. And this provision shall be applicable to all business entities, excluding individuals and HUF whose sales are less than rupees 1 crore in case of business and rupees 50 lakhs in case of profession. So applicable to practically everyone except for the small businesses under individuals and HUFs. Next is again, I would say more of a anti-abuse measure. This is there was section 115 BBD, which provided for a concessional rate of tax at the rate of 15% on dividend received by Indian companies from foreign companies in which the Indian company held more than 20%, 26% stake. So this was continuing for the last 10-15 years. This provision is proposed to be withdrawn from assessment year 23-24. I think this provision was causing some round tripping, and the government was not very comfortable with that. So it's more of an anti-abuse measure. So all the dividends, whether domestic or foreign, now would be treated at par and taxed at the rates applicable to the recipient of the dividend. Yeah. So another, I think I would call it an anti-abuse measure only. It is a set-off of laws in such cases. Amendment has been made to section 79A of the Act. So the government proposes to insert section 79A to disallow set-off of any brought forward loss or unabsorbed depreciation against the undisclosed income pursuant to any search or survey or requisition of books. This would mean basically that the assessee will have to pay full tax on the income unearthed during search and survey. In the past, a lot of search and surveys were happening wherein the assessee was coerced or forced to surrender some income. The assessee and his tax consultants used to advise him to surrender this income in the company wherein there were brought forward losses or unabsorbed depreciation, so that the income is also surrendered and the assessee also does not need to pay any taxes. This was applicable where the surrender was in respect of difference in stock or undervaluation of stock and other things. So with this new section 79A, this would not be possible, and the assessee will have to pay full tax on the income surrendered during the search or the survey. So this is on undisclosed income. There was no definition of undisclosed income earlier. So now the definition of undisclosed income has been prescribed to mean any income represented by money, bullion, jewelry, or other valuable thing, or an entry in the books of accounts which is found during search or during the requisition of the books of accounts. So something that has not been recorded in the books on or before the date of search or requisition or survey, or not disclosed before the relevant tax authorities before the date of search or requisition or survey. So all this becomes undisclosed income. Also, any income represented by any entry in books which relates to an expense and the entry is found to be false during the course of search or requisition or survey shall also be undisclosed income. So this sums up my portion of the changes made to the direct taxes by the current budget. With this, I would hand it back to Dr. Sharma for the continuance.
To Chairman Sahab Shri Mukul Baglaji for a very, very elaborative presentation for the whole scenario of the direct taxes, announcements in the direct taxes, and how these are going to impact the trade and industry and implications at the ground level. So now moving ahead, I would like to invite our co-chair, Ms. Pallavi Dinodia Gupta ji, co-chair of the Direct Taxes Committee of PSD Chamber of Commerce and Industry, for her presentation on the recent changes in the direct taxation announced under the budget 22-23. Shri Pallavi Dinodia Gupta ji, please.
Thank you, Sharma ji. So I'll take this on from where Mukulji has left off. So like he's explained that the provisions are divided into rationalization measures and plugging loophole measures, expanding the tax base. So I'll take care of a few of the provisions which are in this realm as well. So the first one is a welcome step on the tax department reducing litigation. So I don't know what the exact numbers are, but they say that, India is one of the most litigant countries in the world. And so our tax department and us as taxpayers are constantly, litigating against each other on some issue or the other. So the budget has made an amendment that wherever there is a question of law, and that question of law is pending before a jurisdictional high court or Supreme Court, in such cases, the tax department may decide not to file an appeal before the ITAT or the High Court or the Supreme Court. And once the order, if the order is received against the assessee, then the period of limitation of filing the appeal of 120 days or 60 days, as the case may be, before the High Court or the Supreme Court will apply from the date the order is received. What they will also do in the interim is take a declaration from the assessee stating that his issue or his question of law is covered by a decision of the Honorable High Court or the Honorable Supreme Court. Until such decision is made by the courts, that appeal will not be filed by the department. The other measure they have taken is the passing of appeal effects. There is always the case where there is a dispute that has been resolved, but there was no provision that allows the assessing officer to give effect to that resolution of dispute. So this is just an enabling that has been done in this budget to make sure that he's given the necessary powers to give effect to the order of the dispute resolution. The next amendment that the law has done is actually, there was a press release on the 25th of June 21, which is after the second wave of COVID, which affected a lot of us in quite a bad manner. The government at that point in time issued a press release which allowed for people who were suffering from COVID or who had suffered from COVID, to get assistance, to get financial assistance, either for their treatment or in cases where they lost somebody from their family, to get relief or to get financial assistance from either the employer or from third parties or people they didn't know. So where they got assistance from an employer, there it was without limit. And where they got assistance from a third party, a sum of 10 lakhs was determined to be the amount on which no tax will be imposed. So this was a welcome measure. Corresponding amendments have been brought into the Act to give effect to this press release. The next two provisions are widening, deepening, and rationalization of the tax base. So like bonus and dividend stripping was already applicable under section 94, subsection 8. These provisions have been extended to alternate investment funds, to REITs, to InvITs. So these are certain kinds of investment vehicles which were not covered under the bonus and dividend stripping section, which are now being covered. So the scope of this section has been enlarged. The other rationalization measure is on TDS on sale of immovable property. So in a lot of cases, in the last couple of years, what has happened is that in some places, the circle rate was higher than the actual market rate. And in those cases, in some states, like even in Delhi, there has been a reduction in circle rates, or there's been a band within which the circle rate has been allowed to be reduced. Somewhere it's 10%, somewhere it's 20%, depending on the state. So in a lot of cases, what was happening is that the transaction was happening at the market rate, but the circle rate was higher. So in such cases, while the stamp duty was being paid on the circle rate, the tax deduction was being done on the sales consideration. So to bring the circle rate and the sales consideration at par, the amendment has been made in the TDS provisions, which now say that whichever is higher. So if the stamp duty rate is higher, then the TDS will be deducted at the stamp duty rate. And if the sales consideration is higher, then the TDS will be deducted at the sales consideration. So this basically puts the stamp duty and the TDS at par. The other rationalization measure is, if you remember in Finance Act 2021, there were these new sections introduced of 206AB and 206CCA, which said that TDS will be deducted at a higher rate if the deductee has not filed his income tax returns for the earlier years. The section, when it was introduced, defined specified person as a person who hadn't filed his tax returns for 2 immediately preceding financial years. Now, with 1 year of compliance, behind this section, the amendment has been reduced to, the time period has been reduced to 1 year. So now a higher TDS rate will be required to be, to be met if the deductee has not filed its tax return in the preceding financial year within the time prescribed as per 139(1), which is the time of filing its original tax return, and the aggregate of TDS or TCS is more than 50,000. So the Mukulji has left virtual assets or crypto taxation to me. So I'm sure a lot of you are interested, and over the last 10 days I've been hearing it in the news every day. Lots of debates happening on crypto taxation and why it's not called crypto, why it's called a virtual digital asset, etc. So one of the things that there was a if you remember a couple of years ago, RBI had actually come out and said that cryptocurrency is banned in India. After which the Supreme Court struck it down and said that no, you cannot do that, and it's against the rights of the citizens, and therefore you cannot ban this, and it should be permitted. So since the Supreme Court decision, I think a lot of Indians have invested in cryptocurrency or have transacted in cryptocurrencies, which include all kinds of digital currencies, informations, codes, tokens, coins, NFTs. So a lot of these names have been given to various kinds of currencies. And within currencies, there are various kinds of currencies of Bitcoins and Ethereum, etc. So what India has said, and the debate is whether the cart is before the horse or the horse is before the cart. And the view is that, and our finance minister has very clearly said that if there are transactions that are happening in virtual digital assets, then she is, going to tax them. What the contours of the legal proposition as far as virtual assets are concerned will be a question where RBI and the government and the legislature will come up with a detailed bill on that. But till such time that the bill is presented and RBI comes up with the digital rupee, all transactions that are happening on digital virtual assets will be taxable. And taxable at 30%. So, now you're at par with any taxation of maybe speculation or speculative businesses where you're being taxed at the maximum marginal rate. The budget is also only allowing as a deduction the cost of acquisition and no other expenses. So the debate is also that other than cost of acquisition, there are commissions or there are other ancillary costs that are incurred while transacting with digital currencies. So should those not be allowed? As of now, the law is very clear that those are not going to be allowed. Again, no set off or carry forward of loss is possible. No set off of any loss on the virtual digital asset is permitted against any other head of income. No brought forward loss, will be adjusted against current year loss. Now, this is also debatable because if you are going to tax something, then what about transactions that have already taken place before this taxation law comes into place and there is a loss in those transactions? The intention of the legislature vis-a-vis this seems to be that if carry forward loss is not allowed, set off is not allowed, then maybe a brought forward loss also on the virtual digital currency would not be allowed as a set off. But this is a developing law, and one will have to sort of wait and see how it is implemented, and how the litigation on this pans out and how the law develops. This is also a prospective law and not a retrospective law, but whether it will be so will have to be wait to be seen. The other taxation contours of a virtual digital asset is gifts of virtual digital assets. So just like any other gifts of assets above 50,000 rupees, this has been included in the definition of assets. And these virtual digital assets will also be taxable in the hands of the recipient. the exemptions of relatives, etc., that apply to other assets will continue to apply. So taxation on income, taxation on gifting of these assets. And then the third aspect is of TDS on a virtual asset, just so that, you know, in the information system or the tax information system, this information is available with the government on where these transactions are taking place and who is transacting. So a TDS of 1% on the consideration has been imposed where there is a payment for the acquisition of a virtual digital asset. Thresholds have been given in case of individuals or HUFs that have no business or receipts, from business up to 1 crore, profession up to 50 lakhs, no TDS up to 50,000. So these are standard, thresholds that apply in many of the other sections like 194R that Mukulji spoke about earlier. And in all other cases, no TDS up to 10,000. So this brings sort of all digital, virtual digital assets into the tax net on incomes, on TDS, and on transfers of gifts. It also says that this section will override provisions of TDS on e-commerce transaction, which means that these two sections are mutually exclusive, which means either you are being taxed on an e-commerce transaction or you are being taxed on a virtual digital asset. You won't be taxed on both. So, those of you, and I know lots of young individuals in India and lots of millennials are into, trading on the coin exchanges, etc. So, I think that there will be issues of TDS because, not everybody in India has a TAN, and individuals in certain cases are not required to have a TAN. So I think clarification is awaited by means of a circular, or once the bill is in place, then to marry the provisions of the bill with the tax provisions to see how, small individuals who, have invested or have transacted in virtual digital assets will take care of these TDS provisions. This will also hopefully, lead to a large mobilization of tax revenue for the government, because the current estimate of transactions in the digital virtual asset currency is huge. Some of the other rationalization measures that the government is taking is that they have added TCS to 278A and 278AA, which are prosecution provisions. These prosecution provisions were only on defaults on TDS, but they have been extended to TCS now. The other provision which has undergone a change, which I have not seen a lot of people talk about, but can become a large area of litigation, is the fact that Section 179 has seen an amendment. So the erstwhile Section 179, or as it stands today before this budget is approved, is that the liability of directors for taxation or towards taxes of the private limited company only arose where the company was in liquidation. Now the words in liquidation have been removed, which means that if certain conditions are satisfied, then directors of private limited companies may be liable for payment of taxes due from the private limited company, whether it is in liquidation or not. So I think that is a very far-reaching amendment, which may impact a lot of individuals and a lot of directors in companies that are private limited, where the company is not able to pay its taxes for numerous business reasons, and how this liability will flow to the directors will need to be seen, and maybe Sachit can talk about this later about piercing the corporate veil, because till now, unless there was misfeasance or there was negligence, directors were not held to be liable for the company's debts or taxes, etc. So I think this will be an interesting thing to see how this is effectively put into place and executed by the government. So a lot of amendments on charitable trusts. I don't know how relevant it is for a lot of you who are listening to us today, but there have been a lot of amendments to the charitable trusts sections. And the first time I read it on budget day, I think I also did a sort of a double take on, okay, what is it trying to say and what is really happening? So I think the crux of what has happened in charitable trusts is that, you know, there were two types of exemption regimes that ran through sections 10, 12, and 13, which are basically either for funds or institutions or trusts, universities, hospitals, etc., that were exempt under 1023C of the Income Tax Act, and then the different regime, which was for trusts which were registered under 12AA or 12AB, and while they achieved the same purpose, the law was a little bit different for trusts and a little bit different for institutions under 1023C. So basically, what the amendment has done is that it's put at par all those institutions, universities, hospitals, etc., that were falling under 1023C with trusts that are registered under 12AA or 12AB. So the crux of the amendment is that now all of these are at par. The other amendments are that trusts were not required to maintain books of accounts. So the amendment in the books of accounts section in 12A1 and in the 10th provision of 1023C is that now trusts that have, you know, GTI of 2.5 lakhs or more are required to maintain books of accounts. Earlier, this requirement was not there, assuming that anyway the trust's income is exempt. So before you can see that the exemption is applied, so before exemption under section 11, 12, 13 is applied, you will first have to make sure that if the income of the fund, trust or the institution under 1023C is more than 2.5 lakh rupees, they have to mandatorily maintain books of accounts. The other section that they've added is the section on penalties, which is on unreasonable benefit to trustee or specified person. So a new clause for penalty has been inserted, where they say that if a trustee has gotten unreasonable benefit, from the trust, or reasonable benefit has been passed on to a specified person and a specified person is defined, then they will put a penalty under 271AA equal to 100% of the income applied or 200% of the income applied if the default or if the benefit is given more than once. So this is an additional penalty that was not there in the old regime, which has now been added. The other thing that those people who deal with trust would know that, you know, cancellation of registrations or of approvals used to take place. And the government then made an amendment where they said that, no, this cannot be arbitrary now. Even the registration process will be online. There will be no manual intervention. There will be provisional registrations, etc. Now with the Finance Bill 22, they have rationalized this cancellation of registrations and approvals of trusts even further, where they have said that, you know, this can only be done by the principal commissioner or commissioner after due verification of documents or inquiry from a person, you know, and not pass an order unless there is a specified violation. So, you know, the arbitrariness of cancellation of approval has been removed from the statute, and now only in specific violations can this be cancelled, you know. So specified violations are where income is not applied in accordance with the objects of the trust, where separate books of accounts are not maintained for incidental objects, where the activities are not genuine, or there is a non-compliance of some other law. There was a specific reference received from the AO, or an identification has been made through the risk management strategy. So in all of these cases, satisfaction has to be recorded, and only after satisfaction has been recorded can then this registration be cancelled. So these are welcome steps that the government has taken. The other thing is also, when, you know, originally a violation was done, a notice used to be sent, you made a response, and there was no time period in which the order was needed to be passed by the tax department. So the finance bill has also made an amendment to that section of 12AB subsection 5, where they now say that, you know, this order has to be passed within 6 months. So that is also a good step where further rationalization of the sections to institutions under 1023C and charitable institutions apply. Then there is a clarification on taxation of accumulated income. it was understood or it was assumed that for 5 years, accumulation of income is permitted, and if that accumulation has, expense has not been met or out of the accumulated funds under 11.1 or 11.2 of the Act, then tax was paid in the 6th year. The government has clarified that the tax will now need to be paid in the 5th year itself. The accumulation is such till year 5, and you are supposed to spend it within 5 years. So if not spent now, tax will be applicable on the 5th year itself. Then the benefit of this exemption regime will be applicable only if you have filed your returns within time, which is under 139(4)(a). Then there were certain clauses of TDS under 40 AIA, 40A, subsection 3 and 3A, where these were applied to trusts already. These have been extended to institutions covered under 1023C also. Then what are the cases where exemption is denied? Earlier, what used to happen is that if certain conditions were not met, then the entire income of the trust was, taxed at full rate, and litigation ensued. Now, what they have said under 115BB1 is that if there is a violation of the objects of the trust and certain incomes are applied for objects which are not that of the trust, then they will tax only that portion which has been applied for not for the objects of the trust, and the balance will continue to be exempted. Similarly, there is a amendment where contributions are received for renovations of temples, mosques, gurdwaras, etc. In those cases, even though the contribution did not say that it was corpus, practically renovations to such large physical structures could not be made within the time period, and therefore within 1 year, and therefore it was required that these contributions be treated as corpus donations. Now, with this amendment, these contributions will be treated as corpus donations as long as 4 conditions are satisfied, which are that they are applied for the renovation of these physical structures, that you are not using this for a further donation, you're maintaining separately identifiable accounts, and if to the extent not invested, you are investing it in prescribed modes as per section 11. So these are some good rationalization measures that the government has done as far as charitable trusts are concerned and as far as other institutions under 1023C are concerned. When you read it, it looks complicated, but all the amendments are good, and I think will go a long way to make life for charitable entities and 1023C entities easier. The last point that I want to talk about is the rationalization and faceless assessment. I think Sachit can sort of take over from me on this one. He's been, instrumental in a lot of these high court orders where they've been struck down. So now the amendment says that reassessment can be done under section 147 under the faceless regime. The notices in the last year through March and April through June were coming under physical format, and now the amendment, and there was a lot of debate on whether they can be physical or not, or whether they have to be e-assessments or faceless assessments. So the amendment says that 147 can be faceless. Assessee is required to furnish his reply within due date. It can be referred to a special audit also under the faceless regime, and they have struck down subsection 9 of 144B, which says that if the procedure is not followed, then the assessment is non-est, which is what the courts, I believe, were using to strike down these, notices under section 148 of the erstwhile law. So I think these have been struck down, and they've rationalized these faceless assessment scheme. They have also extended the due date for bringing transfer pricing assessments, for bringing dispute resolution, and for bringing ITAT within the ambit of the faceless regime. These due dates by which directions were to be issued were some 22, some 23, March 22 and 23. They have all been extended to March 24. So we're waiting to see what happens, for those matters as well. So that's it from me. Thank you, Sharma ji, for giving me this opportunity, and thank you, Mukul ji.
Thank you very much, ma'am, Pallavi Dinodia ji, our co-chair of the Direct Access Committee, for detailed analysis and presentation on the direct access, recent developments in the direct access. Now, I would like to invite our co-chair, Shri Sachi Jolly ji, for his presentation and decoding the various announcements by the Honorable Finance Minister, Mrs. Nirmala Sitharaman ji, during the budget 22-23. Shri Sachi Jolly ji, please.
Thank you, Sharma ji. And thank you to everyone for joining in. Thank you, Mukul ji and Pallavi, for the lucid elaboration on the proposals. I will take the more contentious ones here. And the first slide, as you can see, is the return of retrospective amendments. I've tried to make grandstand it and make it sensational because that's what it is. See, this government has largely stayed away from retrospective amendments. In fact, if you go back since 2014, they've stuck to the word of not bringing in retrospective amendments. There have been some beneficial retrospective amendments, but none which go against the taxpayer. The present finance minister went a step ahead last year when she made the Section 9, as we call the Vodafone retrospective amendment, to be prospective and settled almost every bilateral investment treaty claim or retrospective tax claim with all the taxpayers. And I think that was very welcome step, both in terms of economics and in terms of reputation of the government, that the government was interested in moving ahead and closing all disputes. But we didn't know that the present bill will bring at least 3, as I have enlisted, retrospective amendments, which will hurt only domestic taxpayers, I mean, largely domestic taxpayers and corporations. The first is on this health and education cess. I think, as everybody is aware, that on the tax and surcharge which is levied, there is an additional education and health cess which was levied from 2005 onwards. The courts, Rajasthan High Court and the Bombay High Court, in 2 separate decisions of Chambal Fertilizers and Sesa Goa, had taken the view that this cess which is levied is a special purpose cess. It doesn't go to the consolidated fund to be used in a particular in a generic manner, but has to be used and applied for the purpose for which it is collected, and therefore to that extent it is different from a regular tax. Secondly, there was a board circular of 1967 which had specifically clarified that the cess which are imposed are outside the purview of Section 48(2). So there was a board circular and 2 high court decisions. And then came a tribunal decision from Calcutta, which said that, look, the high court decisions seem to be incorrect. The circular seems to be in a different context. So therefore, the deduction for health and education cess should not be allowed. Now, the legislature seems to think that the tribunal is more reasoned than 2 high courts, and has gone on to the extent of calling 2 high court judgments as per incuriam. Now, just for de-jargonizing it, per incuriam means that the legislature is now telling 2 high courts that you didn't consider a Supreme Court decision, and therefore your judgment is wrong. Now, I have never heard, I mean, I've seen a little bit of finance bills and we do a little bit of research. I've never seen legislature telling the high courts that, you were wrong, you didn't consider an earlier Supreme Court decision. And what is worse is that the earlier Supreme Court decision does not mention the word cess anywhere in the entire judgment. It's a 1972 judgment. Health and education cess were brought in 2005. I don't know how that 72 judgment can apply to health and education cess. They're brought in through a convoluted logic that in the schedule to the Income Tax Act or the finance bill, the cess is imposed by way of calling it an additional surcharge. Now, there is, I think, ample law, including the constitutional bench in Kesoram Industries, a 5-judge Supreme Court bench has said that the nomenclature you use does not make any sense, does not make any difference to the nature of the levy. The nature of levy of a tax or a cess is determined by the purpose for which the tax is levied. Now, in this case, the legislature has itself called it a cess and to be only used for health and education purposes. So in that sense, in terms of the constitutional bench decision, which of course the legislature in the memorandum does not even refer to, it should qualify as a cess and not a tax. And therefore, to disallow this by way of an amendment when the matter is pending before Supreme Court says, doesn't give any rosy picture or doesn't give any encouragement to taxpayers. The second, and I think briefly Pallavi also touched upon that, is the deletion of subsection 9 in 144B. Now, it's very interesting that in 2021, the government brought in the faceless assessment scheme through the legislature and provided that the assessment will be done in a particular manner. The legislature also provided that if this assessment is not done in a particular manner, the order will be non-est. These were the words of the legislature itself. Now, suddenly realizing that the officers on the ground do not seem to care too much about the processes, the courts are striking down the assessment orders on the basis of this scheme itself propounded by the tax department and the legislature. The government has now proposed an amendment to retrospectively withdraw that subsection, in a sense of saying that we'll throw the baby with the bathwater. We don't really care whether the order is in conformity with the statute. We don't care whether the officers follow the order or not. The order will be valid. You go to the Commissioner Appeals, you go to the DRP, get a remand, suffer 2 rounds of litigation, but we are not concerned with that. Again, this is something where what should have been done was training of the officers to follow the statute and the rule book, rather than saying we'll just remove the rule, which kind of castigates an erring officer. Completely non-business oriented, as I call it, or contrary to fair and equitable tax regime. The third is a very interesting amendment to Section 14A. I think all of us have seen the litigation around Section 14A, which disallows deduction for expenditure incurred in earning exempt income. When the provision was brought in, it was brought in on the book retrospectively from 62. That in itself was a problem, but we've learned to live with it. We've lived with it for now good 15 years. And I think all Supreme Courts, and I can count on my fingers, have all said that unless there is exempt income, there is no question of applying 14A. If you don't have an exempt income, there is no question of a disallowance. Now, the amendment, and as you are aware, last year, this provision was largely made redundant because dividend now has become taxable in the hands of the shareholders. It is no longer exempt. So the provisions of 14A, which were largely invoked in the hands of the dividend receiving entities, becomes largely ineffective. But this year, an amendment has been made to so-called clarify that even if there is no dividend income, still an expenditure will have to be disallowed under Section 14A. What is even more interesting is that it is said the amendment will apply from 1/4/2022. Now, if that be the position, the amendment is innocuous. But how it is structured is it is called a clarificatory amendment. So I won't be surprised if tomorrow, contrary to the stated position that it applies from 1/4/2022, some tax official or some revenue counsels in court stand up and say, look, this amendment, although stated to be applicable from 1/4/2022, only clarifies the position and hence retrospective. So again, if it is applicable from 1/4/2022, it should be said so in so many words that it will not apply to past assessment years. But if it's left to open imagination and said to be clarificatory, I don't see how this helps in reducing litigation. Moving on to my next slide. I think we've covered this, Pallavi, so we can move. This is on the cess and the surcharge. there is another amendment, and I think that creates a lot of clears out a lot of confusion which a lot of taxpayers had, particularly in the pharma sector. And that also was because of conflicting views of different high courts and tribunals. Now, as you are all aware that medical industry thrives on freebies. Doctors are given freebies to prescribe medicines. Now, the Medical Council of India had clearly said that these kind of freebies doctors should not accept. But it did not bar, or in that sense, did not create a stopper on the agencies to distribute freebies in different manners. The question arose whether these Medical Council rules which prohibit distribute or receipt of freebies can be used to disallow deduction in the hands of the medical companies, the pharma companies. There were different views from Delhi and Bombay, but I think the government has stepped in and said, look, if the medical council, and we want to discourage this kind of activity, if the medical council has said this is not permissible, then no deduction should be allowed for this kind of expenditure. The other clarification which has come, and I think in the section 37 again, is that if there is an offense or payment for compounding an offense overseas is made, that will also be disallowed. I think that is fair and equitable. The only thing is generally people compound where they don't want to fight the litigation. It is in that sense not an admission of guilt, although you can only compound legally if you admit your guilt. You can't compound if you don't admit your guilt. But sometimes it is used as a mechanism to buy peace. So if that is the intention of buying peace, I think an omnibus disallowance of expenditure where you have gone for compounding may not have been the right approach. But of course, there is no denying the fact that compounding does involve admission of guilt. You can't really compound if you haven't accepted your guilt. And therefore, to that extent, the disallowance was justified under 37. Moving on to the next slide. Another amendment to section 43B, and I think that goes on from the earlier amendment which was made some years back. As you are aware, 43B disallows deduction in respect of expenses which are incurred but not actually paid during the year. So one of the ways by which some taxpayers would claim deduction under 43B in respect of interest payments would be to convert the interest payouts by converting into into debentures and then deferring the liability. I think the legislature has stepped in to plug that loophole and said, unless interest is actually paid out, there will be no deduction under 43B. And this, again, amendment has been made prospectively from 1/4/2023. Next. Now, again, two very innocuous amendments, as I call it, but may have some bearing on the pockets of the taxpayers. One is penalty under section 271AA(b), which is for search cases, and 271AA(c), where it is in respect of undisclosed income, and 271AA(d), which provide for false entry in the books of accounts, were currently only with the AO. As we are aware that the powers of the assessing officer are coterminous and with the Commissioner of Income Tax Appeals. So therefore, to bring parity, if the Commissioner Appeals finds some undisclosed income and he may want to initiate penalty, then the option of levy of penalty by the CIT appeal has been introduced with effect from 1st April 2022. I think there can never be a doubt on that if the Commissioner can have the power of finding some undisclosed income, then he must also have the power of levying penalty for such undisclosed income. The next, again, is the increase in the penalty amount in respect of certain omissions, which has been increased to 100 to 500. I believe similar amendments should also be made for traffic violations, because those create a lot of issues for us while we're driving on the road. But I think 100 to 500, I don't see a problem in that. If somebody is deviant, must be penalized for that. The next provision is an interesting one. It is, I would call it a rehashing of the existing provisions. Under Section 195A, the Income Tax Act provides that if you bear the tax liability in respect of TDS, if the payer bears the tax liability and has to gross up, then he may approach the Commissioner Appeals under Section 248A after paying the tax on the grossed up amount. There was no provision of applying to the assessing officer for such refund. I think this is a welcome move. It will reduce a lot of litigation if the assessing officer is himself convinced, although it's almost impossible to convince an assessing officer to give you a refund. But at least on paper, you have one more avenue to go to the commission, to the assessing officer to seek refund of the tax withheld and grossed up by the payer. If you are unsuccessful, then instead of a separate appeal under 248, the appeal will now lie to the same commissioner under 246A. So I guess a rehash, giving one more opportunity to the taxpayer to claim refund. The next is a very interesting amendment, and I think there has been a lot of hue and cry in the market on this, on Section 68. Now, Section 68 in simple words provide that if a person who's received some money is not able to explain the source or the genuineness of the transaction, the credit is treated as an unexplained credit. Now, this could apply in a few situations. Share capital or loan are two very common examples. So the legislature had stepped in 2012 to say that it is not enough for the receiving entity to show the source of the payer, i.e., that the source of the investor. They must also explain the source of the source, i.e., if I'm receiving some money in my company, I must be able to explain that the person who's investing in my company has the means and wherewithal and the financial capability to invest in my company, apart from justifying the commercial rationale. This was brought in only for share capital. From this budget onwards, this has also been extended to loans. So if you borrow money from somebody, you must also explain the commercial wherewithal of the person who's lending to you. Now, there are some exceptions to well-regulated entities like venture capital funds and venture capital companies registered with SEBI. But I think the compliance burden on the taxpayer will increase. I don't see any harm, because ultimately, if the reason is to curb tax evasion, these kind of circuitous, or some of the courts have used the word jalebi transactions, should be avoided, where money is put in cash in one hand and then brought in through loan or equity through the other hand. But I guess this will be another source of litigation. Coming to the next slide, and there's been a complete overhash of the proposed amendments, and let me step back a little bit on this. Prior to 1st April 2021, the law on reassessment was governed by the old Section 148, which in turn was governed by a Supreme Court decision in GK and Driveshaft. The law was pretty, as we had called, pretty simple and settled by then, that if you get a 148 notice, you file your return, you seek reasons, you file your objections, and the officer must dispose of the objections by way of a speaking order. If you are not satisfied, you could either agitate this issue in appeal or take it to the High Court in a writ proceedings. I think this has stood the scrutiny of time since at least 1989, when the present provisions were brought in. However, from 1/4/2021, a completely new scheme was brought in. The limitations were changed. The process was changed. Now, the officer did not have to record any reasons to believe per se. If there was some information coming to his knowledge from certain sources, he could first invite the taxpayer to give an explanation on that. He could also be given an opportunity of being heard. And then the notice under 148 had to be issued. So the GK and Driveshaft principle was incorporated, as we call it, prior to issuance of a notice requiring you to file a return. I think it was a welcome step. It left out some ambiguities on how the process will evolve. We also had a series of litigations on when the section will get operative. I think that has been answered by the Delhi High Court in Manmohan Kohli and by the Allahabad and the Rajasthan High Courts. The SLP is now coming up tomorrow, so it'll be interesting to see what happens there. But in the meanwhile, some necessary amendments have been made to section 148 to say that if the sanction has been obtained prior to giving the assessee an opportunity of hearing under 148A, then a subsequent approval from the senior, the additional or the commissioner will not be required before issuing a 148 notice. And I think there is no, I don't see any devil in that, in the sense that there can't be two approvals for the same kind of proceedings from the commissioner. It's just going to add more litigation and nothing else. The second, I think, major amendment in the provisions was, as I had said, under the new law, information could have been flagged by the risk management strategy of the board, or some objection had been raised by the CAG, would have been the basis for initiating 148 proceedings under the new law. The legislature has stepped in to kind of enlarge the scope of what would constitute information. The word flagged has been rightly deleted. It is now called any information in accordance with the risk management strategy. Any audit objection that has been that assessment has not been made in accordance with the Act. Any information which is received from under the DTA, any information available with the assessing officer under the scheme notified under section 135A, and any information which requires action in consequence of an order or a tribunal or court. Now, the kind of parameters which have been now laid down are very generic. It allows a free hand to the tax department to reopen anything and everything without any caveats. The information may be correct, may not be correct. Maybe the information may have already been part of the assessment record and may have even been examined by the assessing officer. But all that is irrelevant today for the purposes of 148 reassessments. I don't know whether these kind of generic conditions for initiating 148 will withstand scrutiny of courts, because if you remember, even when the old law was promulgated in 1989, it only had the requirement of reason to believe. But the courts then built in checks and balances to say reasons to believe has to be based on tangible material. It can't be anything. It cannot be on the basis of change of opinion. Those are statutory safeguards which were built in by the court, judicial safeguards built in by court to stop arbitrary exercise of powers. And I believe in times to come, courts will step in and say that you can't have generic powers to issue 148 notices without any real and new tangible material. Now, there has been a new insertion also. A section 148B has been inserted, which says that assessments concluded consequent to search, survey, and requisitions shall be made by a person not below the rank of joint commissioner. And if it is by somebody below that, it should be with the approval of the additional or joint commissioner. I think this is consistent with the earlier search assessments, which were only made with the approvals of the additional or joint commissioners. There have been some rationalization in terms of the time limits under section 149 for issuance of notice. I think those had to be made to bring practical challenges which were being faced by the tax department in terms of issuance and completions of assessment proceedings. But one significant amendment which has been made under 148 was that under the new law which got promulgated from 1st April 2021, the notices could not be issued beyond 3 years unless income in the form of asset represented by asset more than 50 lakhs had escaped assessment. Now, this raised a very peculiar situation where if the expenditure incurred is worth in crores, but it's been wrongly allowed, those could never be reopened under 148. And I think there were other situations also where there were false books of entries, but those could not be subject to a reassessment under 148. those have been cleared by the legislature, and I think rightly so. It was never the intention that only an asset could be subject matter of reassessment. So I think they've stepped in and said income represented in the form of asset or expenditure or entries in books of accounts which have escaped assessment, which are likely to be more than 50 lakhs, will be subject to reassessment under beyond 3 years, but before 10 years. Moving on, there have been some amendments to the time limits for completion of assessments. The time limit for completion under 143.3 has been changed to factor in where you filed an updated return as per the new scheme, which Mr. Bagla had mentioned, updated returns under 139.8A, and that is before the expiry of 9 months from the end of the financial in which such return is furnished. I think that is very logical that if you are going to allow people to file updated returns, the officer should also have some time to complete the assessment. Secondly, one more aspect which was coming to notice was that invariably when the transfer pricing assessments were made or transfer pricing orders were passed, there was dichotomy of view between different courts that whether the commissioner having jurisdiction over the assessing officer could exercise revisionary powers under section 263 in respect of the transfer pricing order, which is under a different commissionerate. I think the legislature has stepped in to say, yes, those can be subject matter of revision, and accordingly, the time limit for passing the order under section 92CA to give effect to the directions of the commissioner have been changed or modified or brought in to mean that it will be from 2 months from the end of the month in which the order of the TPO is received by him. Pallavi, can we move to the next? Thanks. Again, amendment has been made to section 153B, which says that the time limit for completion of assessments under 153A shall not be applicable in respect of any search initiated or made or after 1/4/2021. And I think those in line with the amendments made from 1st April 2021 have been made, and where the period commencing from the date of search and ending on the date in which the accounts, the books of accounts are seized or requisitioned are handed over to the assessing officer shall be excluded from the period of limitation. And there's a cap on that it can't exceed 180 days. I think again, some period which these are lacunas which were falling into the new regime. I think those have been corrected. I don't see again anything devilish or wrong in that. Finally, on the amendment to section 271AA(b), where search has been initiated, it says that provisions of so and so are the section shall be extended in case of assessments concluded under 148 pursuant to search on or after 1/4/2021. Again, to bring parity or to completeness of the provisions, because now even search assessments are done under 148. So therefore, if the assessment is under 148, natural penalty should be also allowed to be levied pursuant to that if there is any escapement or wrongful misreporting or underreporting of income. I think with that, I come to the end of I've dealt with this amendment in my earlier part. With that, I come to the end of my presentation. Thank you for hearing me patiently, and thank you for Pallavi for putting up the slides.
Thank you so much, Sachit, and thank you so much, Pallavi, for such wonderful deliberations on the various budget provisions. I think now we can move on to the question answer session. I can see a few questions on the chat box. I'm not sure whether there are some on the Q&A also. I can't see them. I have about 7-8 questions on the chat box, so I'll start with these. And Pallavi, if you can see something on the Q&A section also, which are not here. So let's finish with the chat questions first, and then we can move on to the Q&A questions, which unfortunately I cannot view. Probably you can view on your screen, right? So let's start with the questions. The first question from Isha Bansal. is the concessional rate of tax at the rate of 15% under section 115 BAB is for a particular time period or indefinitely? I can take the liberty of answering this. I think it is nothing has been clarified in the act on this, so I assume that it is indefinitely. I hope that the government has no special plans for this, but I think it will be pretty unconstitutional also if someone was to invest today, assuming that it is a 15% tax and suppose after 5 years this tax rate is reduced. So I think that will create a lot of litigation against the government. But as of now, in my opinion, with the law where it is right now, this 15% tax is for an indefinite period. Coming to the next question, which is this says, as per what Pallavi mentioned, is that loss in earlier year cannot be adjusted from profit in trading in virtual assets in future years. Is it fair and logical? Is it not against the principles of carry forward and set off of losses as prescribed in the Income Tax Act, as applicable to other income? I assume they mean the other heads of income for other things. Pallavi, Sachit, Pallavi, you covered virtual, so you want to comment on that?
So I think, Mukulji, the question is really, is our taxes fair and reasonable? I think all of us know that, taxes don't need to be fair and reasonable. Taxes is something, that the government needs to do all the work that it does. Whether we agree or not, I think is secondary. So maybe we feel that at least at this point, this is not fair and reasonable. But, when new laws come, like Sachit was explaining, even in 148, when the law came in 1989, it was different. 14A retrospective from 1962. So I think we need to be a little bit patient with the taxation on virtual digital assets, where, over time, as we learn, the government learns, there will be some rationalization that hopefully will come into the regime. But I think it's too new to expect benefit right now, to expect set-offs or carry-forwards, etc. The hope is that, like you always say, Mukulji, not everything has been accepted, but then there is hope for the future.
Thanks. So there's Pallavi, another question, I think, which is kind of related. It says whether a set of loss is allowed between the two transactions of digital currency. So I assume that this means that two transactions made in the same financial year. So I think, Pallavi, you can go ahead on that one as well.
So my view is that it should be allowed. So if you are transacting in the same virtual digital asset through the year, and on one transaction you made a profit and on another you've made a loss, my view is that they should be allowed to be set off against each other. But again, I think we'll have to wait to see what happens and what the intention of the legislature is. Whether only incomes will be taxed and losses will be ignored, or whether at least transactional set off within the same type of virtual digital asset within the same financial year will at least be allowed. My view is yes, it should be.
Yeah, because I think from what we see in the language, it says no carry forward of loss incurred on the transfer of a virtual asset. So it says carry forward. So I feel like a loss for the same year would not amount to carry forward. So I think intercurrency adjustment should be allowed within the same year. So I have this question, which I'm sure Sachit would like to answer, and he'll probably take about a few hours to answer this one, I'm sure. It says, in faceless assessment, if the procedure is not followed, then how can the assessment order be considered as valid? Is the amendment to section 144B legally valid? Sachit, I can give you maximum 5 minutes for this, because I know you can go on and on this.
No, I don't intend to. I'll tell you whether section 144B9 remains on statute or doesn't remain on statute. The fact is, if you don't get an opportunity of hearing, or if there is a violation of the provisions of the statute, you don't get a draft order, you don't get a show cause, you can always go to the court and say this is not in conformity with the act. 144B9 said something which was obvious, and I think to remove it was kind of uncharitable, as I would call it, Because, it's the obvious thing. If you don't give a person opportunity of hearing, what will he do? He'll go to the court. So I don't think it matters. Even if there is a violation now, you can still go to the court and get the order set aside.
So immediately there's a lot of business coming in for you on this account, right? Next question is, my company wants to set up a new factory at a different location, but in the same line of business, and goods will be sold in the same brand name. Will it qualify for tax benefit under section 115 BAB? Although this provision is not, this question is not relevant to this year's budget, but I'll still take the question. So 115 BAB essentially has got three conditions. First, the company, the company should be a new company. Next, it should start manufacturing before 2024 now, 31st March 2024. And third, it should not have used plant and machinery, like it should not have second-hand plant and machinery. And it should not be formed by splitting up or reconstruction of a business already in existence. So if we look at your case per se, I'm sure you'll form a new company. I'm sure you'll start the production before 31st March 24. And I'm sure you'll have new plant and machinery. So I think the only thing which you need to take care is that your existing business or your turnover from your existing business should not fall substantially, or should not to enable the assessing officer to conclude that you have split up your existing business. So if your existing business is continuing at the same level as before, and you comply with all the other provisions of 115 BAB, then I think you should qualify for the tax rate of 15%. I'm sure if any of the panelists want to have a different opinion, I'm the most welcome to share their opinion.
Absolutely, Mukulji. I was going to say the same thing. It should not look as if, or it should not appear to be that you are now asking your clients to buy from the new factory rather than selling from the old factory. If that is the case, it's a classic splitting reconstruction activity. So, and I think there's been a lot of law under the old section 80J, 80IA, 80IB, 10A, 10B, that this kind of moving the business to a new unit is not called setting up a new business.
Right. Next question is, in our case, merger order has been passed and revised return has been filed manually claiming a refund, but the return is not being processed. What is the remedy available? I think the remedy available is the writ before the courts. I think that seems to be the only case, because I know a lot of visits to the income tax department do not bring much results. If Sachit wants to elaborate on this in respect of the writ, he is most welcome.
So I'll just see practically what I have seen, and in fact, I have advised everybody to first go pillar and post in the department. Even write to the CBDT for that matter. Writing an email doesn't harm you anything. Maybe somebody reacts. You will save a visit to the court. Exhaust all remedies, write to the commissioner, write to the principal chief commissioner, write to the CBDT. If nothing moves, then go to the court. Because see, even if you go to the court is not going to grant you the refund. The court will only direct the department to process the return. Of course, if it's a settled issue, I don't see a problem, but the court will not be, the court may not be inclined to grant you the refund immediately. They may only direct the assessing officer to process the refund. And in that sense, the officer again will have to do the processing. He may find some 26A issues, some tedious mismatch issues. For that, you'll have to agitate it in an appeal. So I would say go to first exhaust all remedies at the department, then go to the High Court, then you will get an order to processing. That's the step. I mean, it's a three-pronged step which you'll have to follow.
Pallavi, what's your take on this?
Sorry, Mukulji, I had bad signal. I lost the question.
I'm saying no, the same question which we were all talking about, where the merger order has been passed and the revised return has been filed manually claiming a refund, but the return is not being processed. What is your opinion on that?
So we are facing this practically where this is exactly the case, and there is no option on the portal to file a revised return. We have filed the return manually. And in our particular client's case, the department actually, to be able to process the return, issued 148 notices under the erstwhile law, and this is prior to 31st March. And under the erstwhile 148, issued reassessment notices on some other reasons to believe, and then accepted our revised return under that 148 regime. But unless such a procedure is established in the statute, I think it's difficult. I think the government is aware of it. I think we have written to, like Sachit said, to CPDT and to other forums where, like in the APA regime, APA has a 4-year rollback option and a 5-year, forward option. So where APAs are entered into, there is an option on the portal enabled by the assessing officer where you can actually go and upload a revised return based on the effect of the APA electronically. I think that option now needs to be enabled also for orders where there have, where mergers have taken place, and the new resultant entity needs to file a return.
I agree. Till now, there was no provision in the Act only to file this revised return, and it was only by virtue of the various Supreme Court orders and various other orders relying on which the people were filing the revised return. So, but now since the provision has been made in the Act, I'm sure they're going to provide a tab on the portal as well, wherein you can file a revised return beyond the normal due date of filing the revised return.
Absolutely.
I think so. Next question, Pallavi. I think you covered this topic during your deliberations. How a layman buyer of property can ascertain the stamp duty reckoner value? He might be even ignorant about such an amendment.
So I think that ignorance of law is not an excuse. I think that's what we are taught when we start practicing any law. So if there is a difference in the stamp duty value and the sales consideration, I think anybody who is helping you through that transaction, these days I think the smartest people are people who help you in transactions, and they charge you a commission for it. So they are the first people to know that the law has changed and now TDS is applicable on the higher of the two values. I did a transaction for somebody last month, and we were looking at a valuation of 2001 because the law has changed. And actually the gentleman who was helping broker the transaction told us that the law has changed now. Now it has to be circle rate, So whoever is helping you through these transactions, they will know. And now I think Mr. Shah, if the question I think is from Mr. Chandra Vijay Shah. So now I know so I'm sure that you will help others as well.
Right. Interestingly, what is happening also is that the registrar himself is quite vigilant about this. So when a registry is done, even the registrar makes sure that the TDS is deducted. And they, of course, ask for the challan for the TDS at the time of registration of the sale deed. So I'm sure they will, even the registrar will make sure that the stamp duty, that the TDS is on the stamp, the circle rate if it is higher than the transaction value. So I think this clears this question. There's a question in amendment to section 37 of the Income Tax Act, Mr. Sachit mentioned expense gifts given will not be allowable as a deduction. Is it applicable to all gifts?
No, I don't think it's applicable to all gifts. It is only applicable to gifts or freebies which are prohibited by law, by any business organization or by any industry organization. Let's say the Medical Council prohibits, or the Chartered Accountants Association prohibits gifts from certain people or relative classes of people, then those will be barred. Merely giving Diwali gifts will not be barred. I think those will still continue to be governed by the old law. In fact, there was a very interesting decision of the Bombay High Court a few years back, which said a construction company gives bakshish to its laborers. Now that in itself, it's not a labor payout, but it's a bakshish which is given generally on putting, as we call it, chat dalne pe dal, to give it. That the High Court took cognizance of and said that's a industry practice. If you want to give it, that is a deductible expense. So I don't think it's on all gifts. It is only gifts which are prohibited by law.
Which we feel are restricted to the medical industry and the C industry. I don't know what happens in the legal industry, but
We receive gifts, we don't say no to any.
Okay. Moving on to probably the last question. In respect of non-monetary benefit given to dealer, how will the amount of TDS be recovered from the dealer? I think it's very well covered in the act. Its proposed act itself. It says, I'll just read it out. In a case where the benefit or perquisite, as the case may be, is wholly in kind or partly in cash and partly in kind, but such part in cash is not sufficient to meet the liability of TDS in respect of whole of such benefit or perquisite, the person responsible for providing such benefit of perquisite shall, before releasing the benefit or perquisite, ensure that tax has been paid in respect of the benefit or perquisite. So therefore, I think it's pretty clear that before you give the gift to the recipient, gift or the benefit to the recipient, you have to collect money from him in cash or debit his account, or if he has an account with you, and then only you make payment, you give that gift to that person to ensure that the TDS is duly deducted and deposited. There is a question from Mani Raju CN. What is the benefit we are getting from long-term capital gains as per new budget? Benefit. I don't.
It's the surcharge. It's the benefit you're getting on long-term capital gains is the capping of the surcharge at 15%.
Okay, yeah. So therefore, I think that's as I had mentioned during in my slide that earlier the rate of surcharge could go as high as 37%. Now that surcharge rate is capped at 15%. So that's the benefit we were talking about. Pallavi, can you see any other questions on the Q&A section?
Yes, so the questions are the same except one question from Sandeep Mukherjee. He says that what happens, does deduction of 194R on payment of benefit give legitimacy to the deduction vis-a-vis the payment? Will the non-deduction of payment affect the claim of TDS in the hands of the recipient of the benefit?
So the fact is that any deduction of TDS would not make the expense legitimate per se, right? You still have to prove the deductibility of that expense to the tax authority. So I think that I wish that was the case. In that case, we deduct TDS on anything and everything, and we get that expense. So I think it's very clear. So the expense has to be substantiated, whether it's allowable or not. Any other views on that? I'm sure. I think we all will have the same view. Since in case we don't have any more questions, I think we can conclude the session. Pallavi, can you just give the vote of thanks and conclude the session?
Sure. So thank you to our leadership, Saket Dalmia ji, who took out his valuable time to initiate and start the session for us today. Sharma ji and the secretariat who helped us, coordinate and put this session together. And Mukul ji and Sachit, my colleagues, my chair and co-chair, thank you for these extensive deliberations. I know clause by clause is not easy for any of us. And lastly, thank you to all the participants for giving us your valuable time and your very patient hearing on the budget 2022. And thank you to PhD for creating this platform which helps all of us come together and exchange knowledge and views. Thank you everyone.
Thank you so much, and special thanks to Sharma ji and his team, Mr. Nanda, and other team members.
All your guidance and support, sir. All the guidance of our chair and co-chairs.
We are
only implementing your ideas, sir.
No. Why the reason I'm thanking you especially is because the whole idea of this program was conceptualized just 3 days back. It's been 3 days to do all the arrangements and to create this web availability and to get so many participants. Thank you so much for your effort. Thank you.
Thank you, sir. Thank you, Pallavi ji. Thank you, Chairman Saab, and our co-chair Satish Jolly ji. Thank you very much, and look forward to more and more interactions in the coming times. Namaskar.
Thank you.
Thank you all the participants for your valuable time, and we look forward to interact with you in the coming times too. Thank you very much.
Leave.